So I'm going to start with a poll, warm us up on the polls. As we go through this on the polls, I want you to know that we can't see who answered what. We just see the answers. So that's why I say you can't answer wrong. Because if you do, we won't know it. Or we won't know who you are anyway. Okay, I am going to end polling. So we've got 60%, 3 people equal, who have and who have not purchased a home before. Perfect. So I'm going to share those results. And we're going to go ahead and launch. Okay. So what we're going to cover here is just to get a comfort level with the process of buying a home, becoming a homeowner. I deal with a lot of people who not only maybe are not first-time home buyers, but they haven't purchased the home in a long time, or they also purchased a home with somebody else and somebody else really took care of everything, and now they're purchasing by themselves. And when we hang up, I'm going to send out a couple of attachments. I'm going to send out a budget worksheet, credit scoring tips, derogatory credit events, and we're just going to go ahead and get into this now. So housekeeping, cameras on if you have them is nice. I'm going to definitely respect your time frame and we'll end on time. If you have a real personal, if you have a question, ask it, please. If it's personal in nature, just wait till we're finished and I can get that answered. And I wrote, please write your questions down so you don't forget them, because I want to address anything that you might have a question about. Let's talk about a few basic mortgage terms. Adjustable rate mortgages, we really aren't doing that much anymore. And it's not so much that they were bad. In my opinion, I've had quite a few adjustable rate mortgages over the years, but it's because the rate difference isn't so big anymore, is what it used to. So it's taken the advantage away of doing that. We're going to talk about appraisals and what an appraisal is going to accomplish, the good information that it gives to you, and also a survey. So a survey is a requirement in Florida. I close in Georgia and Florida. It's a requirement in Florida. It is not in Georgia. I will tell you, I personally, any homes I've bought in Georgia, I always have ordered a survey on. And what a survey does is it shows you the lines of your home. You know, where your property lines are. But it also shows you easements. It will show you if there's a utility easement. And I'll give you one example of that. I bought a home in Atlanta once. It had a great big flat, big yard. And when I put it under contract, I was going to put a pool in. And it turns out I had a colonial pipeline easement running right through the backyard. So I had to decide how badly I wanted the pool. Closing costs and prepaids, we're going over that. Credit reports, we're going over. So down payment and cash to close, we're going to go over these things because they're all terms that come up regularly. Equity is simply the difference between what your current value is. It doesn't make any difference. So let's say you buy a home next month and in 10 years, you're trying to figure out your equity. It doesn't have anything to do with how much you purchased the home for. It has to do with the difference between the current value and the amount that you owe. So any difference between there is your equity in the property. Escrow down here is an account that's set up for the lender to pay your taxes and insurance. And we'll see that in a little bit more depth as we go through this. So, you know, there's always the home priorities list in terms of everybody's not necessarily going to find their dream home. And I always start off with the priorities. I can tell you one of my priorities is the kitchen. The way the kitchen is laid out, I love to cook. So that's a priority to me. And this is where only you get to decide what your priorities are. If you're looking at a condo and you have a German Shepherd, is that going to be a problem? Handicap access, that's actually a big one. I remember closing on a home a couple years ago, and the appraisal came in low, which we're getting ready to talk about, but the home was already completely outfitted for handicap access, and the buyer was handicapped, so they were going to have to spend all the money doing that anyway.
Oh, Toby, we have a poll.
Oh, shoot. Okay, poll. Okay, oh, that's the next one. My next poll's not popping down.
We already in.
End polling, I didn't end it.
On the drop down.
Oh boy, it's a good thing I got Roz keeping me straight here. All funds for down payment must be seasoned for 2 months. And by seasoned, we're talking about have been in your bank account for 2 months. Do you think that's true? Or do you think it can just pop up in your account?
Probably true. Because they like to make sure they have money in it.
Okay, so we're totally split on that too. 50-50 on that answer. Well, I will tell you that that's kind of a 50-50 answer because it depends on where the money is coming from. The bottom line is that if it's coming from a gift, it can be deposited, it can be wired in the day before closing. If it's coming from, of course, the sale of another property, it can be that morning. If it's coming from the sale of an asset, that could be a car, musical equipment, a boat. I've had all kinds of people sell things to have a down payment, an extra car. Here's the deal about if somebody's going to sell something. Documentation. We're going to have to see, we can't just see that the money's in the bank. So let's take a car, for instance. The lender is going to actually see the bill of sale. We're going to need to have a, I don't know if it's the blue book or orange book or purple book, whatever that color of the book is that shows the value of the car. And then we have to actually see a change of title to have that money be acceptable. That is money that does not have to season for 2 months because it came from a bona fide acceptable source. 401k loans are an excellent source of down payment. Basically, if you take one out, you're just paying yourself back. It's cheap money. So the answer is it depends. I will tell you that if it's from cash on hand, mattress money, if somebody's just been depositing cash, let's say somebody has the type of job that they get paid in cash for a lot. That's going to be a 2 months seasoning. Any deposit that we can see, we have to source. That is part of the U.S. Patriot Act. I have to actually take a class every single year on money laundering, illegal funds, and also you're not allowed to have an unsecured loan for a down payment. So that's a 50-50 and it depends. Mortgage insurance. I should have done a poll for this because I can't tell you how many people over the years have told me that mortgage insurance is a ripoff. I don't consider mortgage insurance a ripoff. I consider it an opportunity. Because prior to mortgage insurance, which I think came about in the 40s, after the Depression, I don't remember my dates exactly right, but I think mortgage insurance came about in the 40s. Before that, you couldn't purchase a home without 20%. So here's where I see the opportunity. How much is that same home going to cost somebody by the time they save up 20%, assuming that that 20% is not readily available through one source or another? And what are interest rates going to be? We don't know that answer. If you come into my office, I have 6 framed old mortgage notes that I've had over the years hanging up on my wall. And the first one is from 1981. It was a 1-year adjustable arm at 15.75%. So I've already quoted 2.99% on a fixed rate 30-year loan this morning to somebody. So mortgage insurance to me is an opportunity. It is not a ripoff. That's my view. The difference between FHA and conventional, I should have had a poll here that asks if you think FHA is for first-time home buyers, because many, many people do, and it's not. So let's say somebody has great credit, great everything, and they're asking me about FHA loan. Typically, I'm going to say there's no reason for us to look at that. And we're talking about mortgage insurance. So the difference in an FHA loan is that there's an upfront mortgage insurance amount that gets added to your loan, and there's an additional monthly amount which stays on forever. So even if somebody has 20% to put down, they're still going to have mortgage insurance. If they have 50% to put down, they're going to have mortgage insurance. But FHA serves a really great purpose. And FHA is a lot more forgiving on different credit issues that somebody might have gone through in the past. So again, everything is an opportunity and everything serves its purpose, every decision. VA, of course, is a 0% down payment. Okay, let's talk about appraisals. When you are purchasing a home or refinancing, chances are, I'm going to say 90%, that the lender is going to need an appraisal. What that represents is the fair market value to the lender. And it also represents the condition of the property. You might have an appraisal. I've got an appraisal right now that there's a roof issue on the home, and we're going to close that loan with what we call an escrow holdback. We can't do that for all repairs, but there are certain repairs that we definitely can do it on. On an FHA loan, just last month, we closed a loan that had an appraisal marked subject to, I was just going to do those air quotes. Well, I went ahead and did them anyway, didn't I? Because it's called subject to. And that means that the appraiser says the home is worth this, but it's subject to this being repaired. And on FHA, a common one might be peeling paint outside, like along the eaves of the house. That's kind of a common one. When is it time to order? If you're doing a loan with me, then Roz is going to be holding off ordering that appraisal until your inspection has been done. You have to pay for the appraisal up front. It's $450 typically. And in general, if that inspection has any deal killers in it or possible deal killers that still need to be negotiated between the buyer and the seller, we figure we're not going to spend your money. Now, the only time we might really push for it is if there's a fast closing and that inspection issue drags on, because that could hold up the appraisal. Appraisers are really busy right now. Yesterday I had an appraisal to order and I went through 3 appraisal orders before I could finally find one that would deliver in a week, which is when we needed it for. Who pays for it? The borrower pays for it. And again, we're going to collect that up front. Roz will end up getting your credit card number. So the next 2 questions are ones I get frequently, which is what happens if the appraisal comes in low? And what happens if the appraisal comes in high? Does that mean my loan to value is better? So if let's say you're under contract for, I'm just going to say $200,000, and the appraisal comes in for $195,000. There are 3 choices on that. One is that the seller lowers their price to the $195,000. The next one is that let's say the seller will not lower the price. So the next choice is that the buyer comes up with the difference, because our loan is going to be based on the lower of appraisal or contract price. Now, if a buyer is putting down a large down payment, it really doesn't affect us. But let's say it was a 3.5% or a 5% or 10%, that's when that lower appraisal affects us. And the third option is nobody can agree and everybody shakes hand, walks away. And as long as you've had an appraisal contingency or a finance contingency in your contract, the earnest money is returned. That's a function of how the contract is written. If it's high, again, the lender bases the loan off of the lower amount, contract price, or the appraised value. So contract is $200,000 and the appraisal comes in at $215,000. Unfortunately, it doesn't end up giving that buyer a better loan to value. It's then based on the contract price. And subject to we just discussed, that would mean that a repair needs to be made.
Have a poll.
Thank you. We have a poll. Okay. So now we are going to poll 3. Employment requirement that somebody has to have a minimum of 2 years on the job with the same employer so that the lender can accurately calculate income. Okay. The answer is, wow, we are totally split on all of these. That's great. That's actually great that we are. The answer is no, except I'm going to give you a couple caveats on that. So let me bring that down and let's go to the next slide. If I am counting overtime, bonus income, commission income, then chances are that is going to end up being, can you see this? Pause here?
Yeah. Just click anywhere. There you go.
Okay. Then in that case, chances are I am going to need that same employer for 2 years, because let's say you're a bonus employee and you get, I spoke with somebody yesterday that gets about a bonus on a regular basis, monthly basis, depending on their performance during the month. But if that person changes jobs, and let's say there's the same deal, how is the lender going to have any idea? So in general, that's going to be a 2-year history. Occasionally, I can get away with 18 months. Self-employment, pretty much self-employment is going to be 2 years worth of tax returns. Part-time jobs in general are going to be 2 years, but that doesn't have to be 2 years with the same employer. If I have a borrower that is consistently work part-time, let's say they were 1 year here or a year and a half here, or I've had as many as 3 part-time jobs within a 2-year period, as long as it's consistent and there weren't large job gaps, that's fine. Here's one that a lot of people think is a problem, and I'm going to tell you, in today's world of COVID and people getting furloughed, it's going to be more lax about this as well right now when we come out of this, if you end up having the kind of job that somebody actually did lose their job on. Gaps of employment. A lot of people think you can't have any gaps. Yes, you can. The issue becomes, from an underwriting standpoint, how long was that gap? What was the reason for that gap? And how long have you been back at work? If somebody had a large gap, they just went back to work so that they could qualify for a mortgage. In general, that doesn't work, but it depends. Let's say a mom got out of the job market and stayed home to take care of her child or children, goes back into the job market. I'm going to document the previous employment was steady, and depending on the employment, she might have to be back at her job between 30 days worth of pay stubs or 6 months worth of pay stubs. Social Security, disability. I said VA disability in here, but it's any kind of disability. And child support. These are all issues of how income is gained. Social Security, as long as we have the first check, then we count Social Security. Same thing with disability. Capital gains are going to be on a tax return. So you can see, we look at all kinds of income sources. Asset-based income might be that I'm dealing with a retiree and maybe they have $2 million in the bank, but low income. I can actually take that money in the bank and turn that into a cash flow. I bring all these up because one reason why I love doing this class is what I call, and I think that's on a slide, which is don't listen to your grandma. Because there's a lot of old thoughts about what qualifies for a loan, what to do for credit and what not to do. And just get it from the mortgage lender that you're working with, me of course, and get it from that instead of taking information that could actually cause harm. I'm going to send you this after we finish, understanding your credit report. And it has to do with what makes up our credit score. I'm going to show you a couple of credit reports just so that you can get a feel for what affects and what doesn't. The big one, 35%, is payment history. A lot of times I'll get somebody telling me they're working on their credit. And I go, stop, because we don't want you to do anything that's harm. I have been doing this, the mortgage business, for 33 years now. And I'm going to tell you, it was before credit scoring started. This is where if I had an emoji come up, I would go like that, as in, oh my God, that's so long. This is before credit scoring started. And why I say don't listen to your grandma is what we looked at before credit scoring is very counterintuitive to what we look at now. If somebody has an old collection, an old charge-off, an old something, I may very well tell them, don't do anything about it. Don't pay it off, because if you actually contact that creditor or start making payments on it or pay it off, it could trigger a new negative date of last activity, and then the score goes down. 30% is amount that's due or debt under control with low balances. This is credit cards. This is mostly all credit cards that it's talking about. Here's also an old school thought, which is don't get credit cards, pay cash for everything. Well, that sounds awesome, but in the world of credit scoring, that is not good. Because one of the biggest ways, 30% ways, that the credit scoring models judge us is how much available credit do we have and how do we manage it. Let's say you have I'll keep the numbers simple and I'll say $1,000 credit card, but you owe over 75%, and let's say you have several that have over a 75% balance versus limit available, that's negative. Let's say you go up to your balance or 10 cents over, that's a double whammy on your credit score. Ideally, we want to be under 30%. Now, here's where the awesome comes in for credit scoring, is this is one of the very few things that we can fix, because this is a snapshot in time and it's whenever they reported in last. So I might start off with somebody, I know they've got money, they can pay down the credit cards, and that will bring their scores up, which will ultimately get them a better mortgage. 50%, 15% is the length of history. I'm going to tell you, I have a Chase Visa card in my wallet that says since 1987. I will never cancel that card. So canceling cards also works against you, because it takes away all the, let's say that credit card was open for 5 years. It takes away all the good credit that somebody had, and the only thing it remembers after that is potentially the negative that they had. So I'm going to send this to you. Credit history. Don't listen to your grandma. That's why I said that. Collections, medical may not need to be paid off. Years ago, everything had to be paid off at closing. We can do it at closing, but not now. So if you know somebody, if you have a friend that's saying, oh, I really want to buy a home, I'm working on my credit, say stop. Call Toby, figure out what you need to do and what you shouldn't do. All collections may not need to be paid off. Judgments may not need to be paid off. Now, I'm going to tell you that 3 years ago, I think it's been 3 years-ish, the credit bureaus stopped reporting judgments, tax liens, and foreclosures on the credit reports. Can you believe it? I have to count on somebody telling me now, but the bottom line is it didn't go off your credit. We're going to end up finding these things, these issues based on the back reports the mortgage lender is going to do. So if your friend is telling you that they're going to buy a house because they notice that foreclosure is not showing up on the credit report anymore, or the judgment's not showing up, it didn't go away. Bankruptcy, foreclosure, short sales, all of these things are FHA much friendlier than conventional is. Okay, so we're going to look at a good report here. You can see that these scores are nice and high. I will tell you from a mortgage standpoint, anything over a 740 is going to get the best interest rate. And if that borrower is doing a conventional mortgage and they're going to have mortgage insurance, anything over a 760 is going to get the best mortgage insurance rate. No matter what the score is, there's going to be reason codes here. This obviously, who cares? Oh, that's the next one. So on this higher credit score, it says amount owed, too many consumer. Basically, who cares if the credit score is there? So the next report we're going to look at is a not great report, not terrible, not great. Mortgage lenders are going to use the middle score, not the one that lands in the middle. This just happens to be in the middle, but whatever the three scores are, it's going to be the middle score. Mortgage lenders, by the way, are going to use all three credit bureaus, Experian, TransUnion, Equifax. In this case, we're going to be using a 685 for the buyer. And I think I have on the next one. So we've got a couple things here. So here's the way a credit report shows up. This borrower was 7 times late on a 30-year loan. Excuse me, on a 30 days. I said 7 years. 30 days late 7 times on a loan, and I can see the dates. The date is really important because the more recent the late payments, the lower the credit score. It's more recent, the borrower hasn't had a chance to work that out. This is good down here. It's a $6,000 credit line and they only owe $151. So here's what we call an ugly report. You can see the scores down here. The score a mortgage lender would use would be 594. I will tell you that before COVID, we could go down to 580 and we're at 620 now. So just an example of what the lender sees, we've got a charge off going to 2019. So again, this is fairly recent. Here's a credit card, REV stands for revolving, $200 limit, but they owe 176. So that's where that over 75% comes in that I mentioned. I'm going to send this out to you as well in case you have any friends that you can forward it on to, and it allows you to see what the waiting periods are. We don't really have much for rural housing anymore, but conventional and FHA are probably the most widely used. Okay, liabilities, debt ratios. I'm going to kind of breeze through this because there's another area that I really want to focus on. Student loans right now are in forbearance, but we're still going to count that payment against them. And I will tell you, even if we were not in COVID forbearance and a student loan is not having to be made, we still have a formula depending on the type of loan that we're using. Let's take conventional loan, for instance. There's basically 2 guidelines that all conventional loans fall within. It's Fannie Mae or Freddie Mac, and they have different formulas. So I might choose to go Freddie Mac instead of Fannie Mae because of the formula that I can use. Child support and alimony. If you have a question, just yell it out, please. Tax liens always are going to have to be paid. We cannot close on any loan that has any liens or judgments, but that can be paid at the closing table. Same with federal debt and state liens. So I tell you one phrase that people use that I just don't like, and it has to do with what can you afford as a buyer. it's not about affording. It's about, first of all, qualifying, but second, what is that buyer comfortable with? Because I've done loans for people before that could qualify and on first view afford way more of a house than they were buying. But I've had people I've worked with that has, they're sending their mother money monthly to help subsidize the mother's expenses. Maybe they have special needs child. I did a loan for somebody once that was sending both of her nieces through college. So that isn't anything we see. I'm going to tell you that I ask way more questions than a realtor is going to ask you, because my goal is let's fit into the product that's best suited for you, and let's really figure what it out, because it's not just about affording, it's not just about qualifying, it's about the lifestyle somebody has and the expenses that just don't show up. I'm going to, so if you know anybody that has had a foreclosure or a bankruptcy, it's mostly important to really reestablish credit responsibly, pay bills on time. You can see that from the handout I'll send you. I'm going to send you a budget, which you can just feel free to pass on. And waiting until the last minute to get qualified is just not the way to go. Sometimes it takes planning, and sometimes there can be surprises that popped up. I'm trying to qualify somebody right now who has a terrible score, and I looked at it and I went, you know, what is this about? Because the whole credit report is perfect, except for it turns out they have a joint account with their child, and they didn't realize it because the kid's using the account credit card. They're over their limit, and the last several payments have been made on, not been made on time. They've been made late. So sometimes we never know. One of the best stories, best as in awful stories, was somebody I was doing the loan for several years ago. Awesome credit, except for the month before I pulled credit, he had had a ticket, a parking ticket of some kind in New York. And he said he didn't know about it. I forget if he said he didn't know or he forgot about it. The ticket was never paid. And 4 years later, that New York, Manhattan, turned it into a judgment against him. And those kind of public records kill your credit score. They just kill them. So that's why I say never ever wait until the last minute. And the other thing is that you can't make an offer without a pre-approval letter, because no listing agent or seller wants to have their home tied up with somebody that can't close on the loan. The new F word, forbearance. This is big right now. Let's say that a mortgage has been put into forbearance because the mortgage lender called and said, you're eligible to go into forbearance. Do you want to? And the borrower says, okay, that means I don't have to make my payment for 3 months or 6 months. Well, you know, that kind of hurts in terms of getting a new mortgage. And this, by the way, doesn't matter if you've co-signed on something. If your name is on it, you're on it. So in that case, the borrower has to either catch up the late payments, enter into an agreement with the lender to tack those payments onto the back, and make 3 months of on-time payments. That would be the same for a car loan in forbearance. Student loans don't count because those automatically went into forbearance, but any type of installment loan or mortgage. So it is pretty important. And then we as the lender, And when I say we and lender, I'm talking about all lenders. This is guidelines now for mortgage qualifying. And I'll tell you something else. If somebody has a job or is self-employed, we are, up until the last minute of the closing, verifying that employee is still working. We're going to get extra pay stubs along the way, and we're going to confirm that the business is still open and operating. So just the world we live in right now. We've already touched on this, conventional FHA. Obviously, to qualify for a VA loan, somebody has to be a veteran. There's no free lunch, and there are good sides to both of these loans. FHA, you know, somebody might poo-poo because of the mortgage insurance, but frequently FHA has a lower rate than conventional. And if I'm working with anybody that has lower than a 680 score, I am comparing FHA to conventional, because on a conventional mortgage, the interest rate and the mortgage insurance are completely dependent on credit scores. With FHA, they aren't. With FHA, they can be the same rate, the same mortgage insurance, no matter what the score, as long as the buyer qualifies. So anybody below a 680 right now, I am comparing FHA to conventional. There is a conventional 3% down program that a lot of people don't know about. So FHA is 3.5, conventional is 3. There is an income limitation to that program, completely depending on where that buyer is buying.
Toby, we have a poll.
Okay. So let's talk about finding your home and working with your realtors. Who does that drip benefit? I'm going to talk about what a drip is, but who does it benefit, the buyer or the realtor?
Yeah, I have no idea what it is, so I can't make a comment.
Okay, when you are working, well, I'm just going to end that poll then. We'll talk about the drip campaign. We're going to go down here. Okay. What is a drip campaign? When you are working with a realtor and you've kind of set out the parameters of what you want, what you're looking for in a house, I guess the next poll is who is on a drip campaign. You're going to start getting automated emails from that realtor for new listings that have come on the market that fit into your parameters. So the answer to that question is it benefits both of you. It allows the realtor to keep you up on what's happening. It's not just new listings, it's, let's say, a price drop. It's going to automatically send you notice of that. For you, it benefits you because it keeps you really aware. It lets you know. I'm going to tell you that if I'm talking to somebody that says they're going to try and find their home themselves and not buy with a realtor because they think they're going to save money, that is a no way. That just doesn't happen. A realtor is going to be able to really educate you on the market. They are going to help you figure out what to offer maybe on a home, and we're going to really get into offers coming up next. So a drip campaign, any of you shout out if you are on a drip campaign, if you're automatically getting emails from your realtor. Tom, you're in Toronto though. But it's the same thing. It's the same thing. You have drip campaigns. So these benefit both the realtor and the buyer. And let's say you change your parameters. It's really important for the agent to know that, because then they're going to change the parameters of what they're dripping to you. And it's called drip because it's drip, drip, drip. You know, you get an email every day or every other day, depending on what's going on in the market. So you definitely want to make sure that you are working with that. Condo versus single family residence. It's a lifestyle choice. There's no good or bad. It's a lifestyle choice. I did a comparison here working with a $300,000 single family home. SFR stands for single family residence, with 20% down. And let's say the principal and interest on that at 3% is $1,012. So you still have taxes, still have insurance, maybe have a homeowners association fee. Versus a $250,000 condo, same 20% down. The condominium rate is going to have a little bit higher of a price. It could be, this could be 3 1/8, it could be 3 1/4. It strictly depends. It's not a black and white formula, and it strictly depends on that day's market. So let's say the 250 with a $300,000 $300 HOA is going to be that 1,012 to the 1,170. But what does that HOA include? It is going to include your trash. It may include basic cable. It may or may not include water. I was super interested in a condo once when I was in Atlanta. It was in an older building up high overlooking Piedmont Park. And at first the HOA fee was, this is a long time ago, so a $400 HOA fee was really high. And I went, oh my God, $400. But I came to find out, because it was an older development, it actually also included the heating bill. Now, of course, if you're in Florida, you can care less about the heating bill most of the time. But in Atlanta, it makes a difference. So what does that HOA include? Your taxes will pretty much be the same. Your homeowner's insurance is going to be less on a condominium, because the condominium, part of those HOA dues for a condominium include what we call walls out. So once you walk outside your door, the condominium is covering, the master insurance policy is covering the roof, the siding, whatever is going on there. I do want to bring up one thing, and that's townhomes. There's a lot of townhomes that can either be condominium owned or not. The difference is whether somebody owns the land. That little postage stamp. I've had 2 townhomes. One was owned as condominium and one was not. So you can't tell by looking at it. That's something that your realtor will be able to explain to you. They'll be able to see that in the records. And I'll also tell you, we have had circumstances where the listing was wrong, and the listing agent put it down as if it was not a condo, and it is. And again, that makes a difference. So you can't tell if you're looking at townhomes. Just know what you're looking at, but it's strictly a lifestyle choice. In my home, I have a pool guy that I pay. I've got a yard guy that I pay. I've got the guy that comes around and sprays for bugs outside, and the landscaping shrubs. So it is just a trade-off with what you want. Choosing your realtor, let's talk about that, because I kind of changed my mind a little bit on this. And I have always thought, oh gosh, I only am going to want to work with a realtor that's been around for a super long time and knows everything about everything and totally knows my area. And I've kind of changed my mind. There was an old ad, I haven't seen it in a super long time, and it was either for Hertz or Avis, and one of them was number 2. And basically they said, we try harder. So I think what you want to do is choose somebody that you have confidence in, that you enjoy working with, that you feel is really listening to you. And I always remember that that car rental ad, because we're number 2, we try harder. As far as the location goes, that's kind of an it depends. And it might also depend also if you have children and you want to know more about, you know, what's available on there. But with the internet now, gosh, you can find anything. So choosing your realtor, to me, is more a function of who are you comfortable with, who do you have confidence in that's really doing the best job for you. Does that make sense?
Yeah.
Willing to educate and answer questions, and if they don't know the answer, to find out. I got to tell you, for me, as long as I've been doing this, I get questions all the time that I don't know. We have we call it a scenario desk with my company, and I type a question in, and we have 2 underwriters that man that scenario desk. I type in stuff all the time, whether, you know, what do you think about this, for an opinion, and sometimes they have to look it up. So just, you know, working with somebody that's doing a great job for you. How do you read a listing? This is an old listing. I didn't pull up a new one, but basically they're all the same. And they're going to give you the price. They're going to tell you probably what subdivisions or condominium developments you're in. They're going to tell you the tax year and how much the property taxes are. Now, I'm also going to tell you junk in, junk out. So if the listing agent has not prepared this properly, it's not going to be correct, just like I mentioned the condominium townhome that was not listed as a condominium. It's going to maybe not give you room dimensions, square feet. So there's a lot of information on there. I can tell you, if it says need some TLC, that means when you go in there, it doesn't just need a carrying owner, it's going to need some work. So work with your agent on how to decipher, you know, some of these. Also, you may or may not get a seller's disclosure. In Georgia, you always get a seller's disclosure with a contract. In Florida, not so much. The seller's disclosure is several pages long, and that seller is required to talk about any structural issues they've had, any roof issues, termite damage. Now, just because something's had termites, it's been fixed, that doesn't mean that's not a deal killer. Water intrusion. I'm going to tell you a story on a home that I bought once. Bought the home. The seller told me there had been no issues with that. And I had a downstairs, and it turns out water, when it would rain really hard, water was seeping in from around that little outside porch area into the downstairs, creating mold and ruining any clothes that were in there. And I just kind of thought, well, damn, you know, it's my bad, until I went in the basement, the other part of the basement, and I found a stop leak can in the basement. So that seller wasn't exactly truthful. He figured he had fixed it. So he ended up having to pay to have French drains dug all around my house to fix it. So like I say, in Georgia, you always get one. In Florida, you don't necessarily. I would ask your realtor for one.
Yeah, can you request one from the realtor?
You can. So here's what can happen in Florida. And it's the listing agent that's going to give it to the seller, not the buyer's agent. But in Florida, what happens is we have so many second homes or investment properties down here that the seller says, oh, I don't want to fill one out because I don't live in it. Well, to me, I'm just saying, to me, that doesn't mean they don't know what's gone on in it. My home here in Florida, I rented it out for 14 years before I actually moved into it. And I know that I've had to have it replumbed. I know the roof has had to be repaired. So I may not be living it, but I know what's going on with it in general. Plumbing, this is just going back over this. Homeowners Association restrictions. Now, on the Homeowners Association restrictions, I'm going to tell you that seller, if they fill this out, they're going to tell you the best to their knowledge. They may or may not even be aware of something that's changed. That's something you can get directly from the HOA.
Now, questions on the HOA.
Yes.
I've noticed some of the properties that I've seen, they'll have like a $6 a month HOA or $50 a month HOA, but it's not actual an HOA, although some of them will be like, we need to like pre-approve you before you move into the neighborhood, which I just delete because I don't need to be approved into anybody's neighborhood.
Okay.
What is the difference
in Florida, if you're buying into a development that has an HOA, if they have a fee, they've got something going on. I mean, but in Florida, you pretty much always are going to have to fill out an application to be able to move there. I think it's very discriminatory myself, but I guess it's a profit center. I don't know, I personally think it's discriminatory, but in Florida, if there is an association, you're gonna have to fill that out. And that's one reason why we don't have a whole lot of VA approved condominiums, any actually in Charlotte County, because VA won't allow anybody to buy into a potentially discriminatory situation. If you really want to buy something that has an HOA, just kind of change your mind. You're going to have to fill it out. You're going to have to probably pay them $100 to approve you. There are some areas that, there's an area not far from my home that is on a golf course. And I actually just learned that if you buy a home and your backyard is that golf course, you may or may not elect to be part of that extra little cost on it. And really what they're doing is they're paying for keeping up something that might become an area. So they usually serve their purpose. Have you all seen, and here's on the disclosure page, something that the seller can fill out to explain anything. Like it did have termites, but it was fixed, sort of a thing. Okay.
We have a poll.
What's that?
We have a poll.
Okay. Did I just mess it up?
Maybe.
Last poll. Last poll. Who pays the closing costs? The buyer, the seller, or everything can be negotiated? Okay. So pretty much, well, not pretty much, everybody got that one right. So that's everything can be negotiated. I really want to get into this because this is something I love. I actually teach realtor classes about what we're going to go into, because depending on where they're from, depending on the area that you're buying, some areas have very standardized, I'm just going to call them standardized, check off the box, this is the way it is here. That is not the way it has to be. So what can be negotiated? Pretty much everything. How much can the seller pay? This is a, this depends on the loan, how much the seller is allowed to pay. So I'll just throw out a conventional 5% loan. The seller is allowed to contribute up to 3% of the sales price, not of the loan. They can never, however, contribute more than what the actual costs are. If they agreed to pay $6,000 and the costs come up to $5,489, they can't give the buyer the rest of that money at the end. However, if there was no homeowner's warranty in that contract, and I've got money left over, I'm going to use up every penny I can. The seller already agreed to pay it, so let's use it up. And that's what we might do for it. What type of allowances can the seller make? Years ago, we used to be able to have in the contract things like seller gives a painting allowance for $500 or a carpet allowance for X amount of dollars. No can do that anymore on any loan. However, what the seller can do is just have that be paid a closing cost contribution. It's just worded differently now. And what difference does it make to the seller? I have had realtors walk into my office kind of mad at me because I might be working with a buyer that doesn't have more money than they need, which is most home buyers, you know, a large percentage of home buyers. And not only that, instead of spending the money on closing costs, maybe the home needs, maybe you want to replace the flooring or replace the countertops or something like that. So it's not just a matter, just like how much can you afford, which I don't like. It's not just a matter of how much money can you afford to pay. It's where is your money most useful to you? So I've had agents come in and say to me, why would my seller pay closing costs? And the answer is because they want to sell the home. And the other is, what difference does it make if they negotiate the price down versus keeping the price up and instead using that money to contribute costs? It doesn't make any difference to them. It doesn't increase their tax liability. It's just all the same. So, and I've had sellers say to me, nobody paid my closing costs. Well, sorry about that, you know? So everything is negotiable. Okay. It is not just about interest rate. I've taken, now I'm going to tell you these interest rates look high for today's world, but this software is no longer available to me. They turned this awesome. I bet I used this for 15 years, and they turned it into some fancy high-tech thing, and so I can't use it anymore. So the rates are irrelevant. It's the concept that I want you to understand. How can closing costs be paid? They can be paid by the, They can be paid by the buyer. They can be paid by the seller, or both. Or they can be paid by the lender. There's a way, if I've got somebody short money to close, there's a way that I can increase the interest rate and have lender paid closing costs. So this is an example of that. Interest rate versus cash to close. $250,000 purchase, 5% down. So you can see going all the way through, the loan amount is the same. In this case, we're going to go all the way up to 4 3/4, which sounds way higher than 4 3/8. But let's look at the payment difference. The payment difference is $53 a month. And in return, we saved almost $5,000 out of the buyer's pocket. So would you say that that is maybe a good trade-off if it means buying? That's why I'm saying it's the concept, it's not actually the interest rate. This does not work well on lower priced, on lower mortgages. It doesn't work as, darn it, doesn't work as well on lower mortgages. So pretty much once I get into that 200,000 range on a mortgage, it works much better. The higher it is, the less of a rate increase it has to be to, well, I'll give you another example on this one. This doesn't have to do with closing costs, but we talked about credit scores earlier. Let's just say somebody's credit score is lower, and in turn, they're going to have to pay a higher rate on a conventional loan. Is $53 a month worth not buying the home? How much are interest rates going to be, or the price of that home going to be, once somebody is able to get their credit score up to what it's want? So to me, buying a home is all about opportunity. I love what I do after all these years because I'm such a believer in home ownership. I really am. Okay, here's another example. And again, call me out questions on this, because I get questions all the time from realtors about this while I'm teaching the class. Price versus payment. Let's say you're looking at a home and, oh my God, you love it. It meets all of your needs. It met those parameters, and the seller is asking $260. But you or your best friend or your father is saying, don't pay them that, offer them $250 instead. And so you kind of get stuck in the mode of, I want a deal. Well, here's what the difference is. This is on a 250 going all the way up to 260 for a purchase price. The savings is $52 a month in this scenario using these interest rates. Is that really worth digging your heels in the sand versus buying the home and spending $52 extra a month? So here's a real example. I had somebody I was working with, she was in Atlanta, and she was telling me she just can't afford to go up to the 260,000 in this case. And I said, well, I'm looking at your bank statements, and I can see, because she was using her debit card for everything, and I can see that you're probably spending $1,000 a month to go out and eat. By the time I add all this up, can you give up a meal to buy the home that you love? And of course, we closed on it, because when you put it into perspective, it makes sense. So here's another example of not just thinking, I'm not going to pay that much. It's another example of cash for closing and negotiating. Let's say the home is listed at 260 and you want to negotiate that to 250. Cash to close in this case was price versus payment, 260 for and a half. Total cash to close. Oh, I got something screwy in here. But you can see that the payment difference, if the seller was to pay all of the closing costs at closing, that's weird, I never noticed that before. Monthly payment, that's right, net savings. Oh, this is not a cash to close example, sorry about that. This is price versus payment. Just showing you, if you go up a little, especially with today's ridiculous rates, it just doesn't make that much of a difference. The house has to appraise out. The appraiser does get a copy of your contract, which does help to influence a value, because it basically is indicating what a seller is willing to sell for and a buyer is willing to buy for. The loan estimate, when you go into a binding contract, one of the disclosures that you will be sent is going to be a loan estimate. And that's going to be an estimate to the best of the loan officer's ability. I mean, we've got to just start off guessing for insurance, which I'll tell you is a lot harder to do in Florida than it is to do in Atlanta. And we're also going to be guessing at other things, attorney's fees, stuff like that. So it's going to be in the ballpark. But when you get to closing, you're going to have a closing disclosure. And the example that I pulled, just because it would take too long to go through both states, is I pulled Florida because Florida has the highest closing costs versus Georgia. So I pulled Florida off. You can hardly see this. This was a live one that just closed in April. But this is what a closing disclosure looks like. If you've ever bought a home before, and it was prior to 2015, prior to 2015, I think it was, we have a whole new, it's not called a HUD or a settlement statement anymore. It's called a closing disclosure, and it's a very different format. The first page, of course, is going to lay out the loan. So we can see up here, barely, that the purchase price was $414,500. In this case, we had a 20% down. I think that comes to 20% if I get my calculator out. We have a loan of $331,600 versus 414. What is that? 414,500. So that is 20% down. Monthly principal and interest payment is showing here at $1,512. And we come down here and we've got taxes and insurance. So this first page, when you close, and it doesn't matter what state you're in the country, by the way, this is going to be the form that you're going to close with. Then it comes down here and it breaks out your taxes and insurance. It's showing you what your monthly obligation for that is. So if you add your principal and interest, your taxes and insurance, and also if you have mortgage insurance, this is going to show you right here what your final payment is. And then page 1 is also going to show your cash required for closing. Your cash required for closing is going to be minus however much you put down for earnest money. So let's say you put down $5,000 for an earnest money deposit. This is going to reflect you getting credit for that. The second page of your closing disclosure is going to itemize all costs. Well, I tried so hard to get this looking better, and since it's a final one is scanned in here, this is what I was getting. It's going to itemize all of your costs, and there's different rows for who's paying what when. In this case, I mentioned earlier, you're always going to have to pay for your appraisal up front. So this is indicating that the appraisal was $450 and that the buyer has already paid that amount. This is showing what the seller is paying over here. So this is going to show all costs involved, including the escrows for your taxes and your insurance. This loan estimate originally was $97,000 for cash to close. Oh, I know why. $97,000 for cash to close, and their actual cash to close was $82,900, but it's because they were not credited. We don't credit a buyer for an initial disclosure with how much they have put into earnest money. So in this case, this did not take in earnest money into consideration. And then page 3 really itemizes, again, the whole transaction. You can see the purchase price here sales price is $414,500. Borrowers, all of the buyer's costs added up to $11,700. They have to reimburse. This is always prorated in your contract. The seller had already paid some monies in advance for some taxes that were due. So the buyer is reimbursing. This could be for trash, depending on where you're buying. It could be, because some counties collect on an annual basis. It could be for homeowners. It could be for a bunch of things. So total cash required from the buyer is $426,500. But let's go into the buyer's credits. The buyer paid $7,500 for earnest money. Their mortgage amount is $331,600. They're getting a seller credit for $2,000 that was in their contract, a $2,000 credit. And also what was in their contract was that the seller is going to pay for their title insurance in this case. So that has all of these. The seller, this is going to be in your purchase contracts as well. It's actually pre-written in, is that the seller is going to be responsible from property taxes from January 1st up until the day you close. And so this is the seller's portion of the taxes that are due. So all of these end up being credits to the buyer, which end up coming down here to the final cash to close, which we saw on the first page. Here is, go ahead.
I have a closing question with the inspection.
Yes.
Because of all the sales and all the delays with the inspections, can you close without an inspection?
Are you talking about an appraisal or a property inspection?
The property inspection.
Okay, lenders don't get the inspection. So the difference is the appraisal is telling the lender how much a property is worth and what the condition is.
Right.
A property inspection is done solely by the buyer, and we don't get it, we don't want it, it's not a requirement, and it's not part of the closing disclosure since it's not a required function of the closing.
Okay.
I will tell you, unless you're a contractor, you just never know what's going to come up in an inspection. You just never know, and that's the reason why you want to hire a certified home inspector. Because they have gone, different areas have different requirements for certification. And I personally would always hire a certified inspector, just like your realtor, just like your loan officer. We've had to go through certain education. We have to keep up every year with continuing education. So does that answer your question? An inspection is not going to have anything to do with a closing.
Now, could it hold up the closing?
It certainly could hold up the closing if the buyer and seller are still negotiating the repairs that might need to be done. So let me tell you if it holds up a closing. That interest rate probably is already locked in. And if the interest rate expires, then an extension has to be paid. So there is a fee to extend an interest rate. And you don't get to just say, oh, well, I'll just take today's rate. Lenders don't do that. It has to do with a totally different level in the mortgage industry. And so if it does hold up a closing, somebody's got to pay for an extension, is basically the way that goes.
And that could be negotiated with the seller if there's a lot of issues.
Depending, exactly, depending on what that was. It might be. I mentioned earlier I have a big roof issue right now that so far we know will be at least 5 days late in closing, because what happened was the buyer wouldn't allow us, they wouldn't pay for the appraisal until they worked out the roof issues. Well, that made us really, really late on the appraisal. Roz, I think, called them, we were getting desperate to order the appraisal. And so far, the best delivery date I could get was going to be more than a week. So it's an it depends answer. Yes, everything is negotiable, really. Everything is negotiable. I do not like 15-day inspection periods. Personally, if I was a seller, I would require a 5-day inspection period, because if I'm going to have issues with a buyer, I want to know about it. If the deal's going to fold, let's let it fold. If I'm going to have to fix something, let me get it fixed. So give me plenty of time between then and closing. Depending on the contract that you're writing and the realtor that you're working with, some of them will extend it out to 15 days. If I was a seller, I would not accept that. Just so you know. Did that answer the questions about running late?
Yes.
Okay.
Yeah.
Additional information, you can't read this. I can't even read it myself, but it does show, this is clicked off saying that maybe there's no prepayment penalty. No conventional FHA or VA loans carry any prepayment penalty. If you close on the home tomorrow and over the weekend you win the lottery, I will be so happy for you, and you can pay the loan off without any penalty. Choosing the lender. I have a problem sounding negative, but I'm just going to tell you, if you tell your realtor that you're going to close with Bank of America or SunTrust or something, they're going to ask you to close with a lender. The big banks are notorious for late closings. What are their hours of operation? Are they going to close the doors at 5 o'clock? Will they answer your call on the weekend? What is their breadth of knowledge and experience? And are they willing to educate you and answer your questions? And also, what about the programs that are provided? I'm going to tell you right now, there's nothing really creative going on for mortgage programs. It's pretty much fixed rate loans. You can close on a 15, a 20, a 30-year loan. FHA and VA, the key is working with a lender that's going to help you choose the right product for you. That's really what the key is. And who will service your loan after the loan is closed? A lot of people like to close with Wells Fargo because they think Wells Fargo is going to be, because they want their payments to go to Wells Fargo. It doesn't matter who services your loan. What you sign at the contract, at your closing, you're signing a contract with the lender, and the terms of that contract can never be changed. Your taxes and insurance will be changed in your payment as your taxes and insurance go up or down, but the terms of that contract will never be changed. And it doesn't matter who services your loan. We service about 50% of our loans, but it doesn't even matter if we are or not, or if the lender down the street, you know, chooses to do that. It doesn't matter. I will say one thing about choosing your lender. This is something that the agents really love. For instance, on my loan panel, both in Florida and Atlanta, I get to choose who's on my panel. We call it an appraisal panel. And I get to choose who's on my panel. If you're doing a mortgage with, I'm just going to pick on Wells for a minute, their panel could be, oh my God, way far away, and they might get somebody that is living in Waleska and wants to come into Atlanta for the day because they got some Atlanta errands to run, or here in Florida, they could be in Sarasota, but they haven't been to Punta Gorda for a while. So I have a very small panel. I want my appraisers to know me. I want my appraisers to be dedicated. I just said I went through 3 appraisers to get that one appraisal chosen. And each one of them called me to say, could I do here? Could I do there? And they were all very reasonable. But this is the roof deal that just waited so long. And finally, I got a hold of one of my 3 appraisers and I said, I've got to get you to do this for me. And she said, of course. So the appraisal from a local panel is important. Was this helpful? I hope somebody says yes.
Yes.
Yes, definitely.
Yes.
Can anybody tell me something maybe they learned that's different than what they thought?
This is Steve, I can say I've gone through and bought several homes, but they've been in all different states and there's all variants. So I'm trying to get in tune with what's Florida doing. So I think it was very helpful.
Thank you, good. And that's the goal. If we hang up and in an hour or in a week or in a month, you think of a question, just please answer me, question me so I can answer you. And then I have a favor to ask of you. Besides you, if you have a really good friend or your cousin that needs thinking about buying a mortgage, just thinking about getting pre-approved, will you do me a favor and them a favor as well and connect us? I would appreciate it. I know I'll do a very good job for them as well as for you, and I know that they'll appreciate it as well.
Sounds good.
We are right when I said it would end. And if anybody wants to stay and yell out any question, I am happy to stay and answer. I hope you all have a really successful day, and I'm glad that you joined me today.